Hey, what's up, everybody? It's JP. Today we're going to learn journal entries with some help from The Office. Accounting doesn't always have to be boring, so today we're going to have a little bit of fun and do some journal entries, some debits, credits, and at the very end we'll make a trial balance and financial statements, including the income statement and the balance sheet. Before we start, question of the day really quick. What's been the hardest part of learning accounting for you? Leave a comment below and we'll see what everybody says. Okay, our first transaction here. Michael Scott invests $10,000 into his new business, the Michael Scott Paper Company, with cash. I'm sure this is going to go really well for him, as we all know. So, an investment into the business. We first know that the business is going to be receiving cash of $10,000. The tricky part of this might be the credit. The investment into the business is going to be considered equity. We'll call it owner's equity in this case. It could be also called shareholders' equity or simply equity, but that will be our credit. Cash increases with a debit, and equity accounts increase with a credit for $10,000. Today we're also going to be using T-charts. I think T-charts are a really valuable tool when you're learning accounting and doing journal entries. So we're going to take this journal entry we just did and put it in a T-chart. So real quick here, we have to create two new T-charts, one for cash and one for owner's equity. The debit goes on the left side of 10,000, and then the credit for the equity goes on the right side, the credit side of the T-chart, 10,000. We'll keep some running totals here, and this will help us later on make our trial balance and then do our financials. Okay, our next transaction. Michael purchases laptops for his staff for $5,000 each. Laptops, not just laptop batteries this time. Okay, the debit here again is going to be, we have an increase in assets this time. We're buying laptops, and we're not going to expense them in this case. This would be given to you, but we are going to actually debit an asset account. So I'm going to type in asset laptops for $5,000. And then the credit, again, since we're paying cash, cash decreases with a credit. So we will credit cash for $5,000. Okay, same thing as before. We'll put this in our T-charts. So now this time we have a credit for cash, so that goes on the right side of the T-chart, 5,000. And then we have a new T-chart for asset, laptops. That is, again, an asset account, so it will carry a debit balance, and it goes on the left side of the T-chart there for $5,000. Our third transaction, Michael pays his monthly rent of $500 with cash. $500 for that really nice storage closet. So this time we have rent. So rent is going to be a type of expense. We'll call it rent expense. Expenses always increase with a debit. So the expense is going up for us. So we have a $500 debit. And again, we have the credit of cash, right? We're paying out cash, so that's a decrease in cash and all assets decrease with a credit. So debit rent expense for $500 and credit cash for $500. Throw that on our T-charts here. We'll make a new T-chart for rent expense. We'll add $500 there on the debit column. And then cash, we will add the $500 on the credit column. And you can kind of see here already, we're getting a lot of transactions in this cash T-chart. So it really just helps us to see the activity and to kind of what's going on, what's coming in, and what's coming out. And later when we go to do the totals, it'll make it really easy as well for us. Okay, what's next? Pam orders some paper from a manufacturer to resell. The paper costs $1,000 and she paid on credit. Okay. So since the Michael Scott Paper Company is in the business of buying and reselling paper, when we buy the paper for resale, we're going to consider this what we call inventory. Okay. Inventory is a type of asset, so an increase in inventory is going to be a debit for the $1,000. And then the credit here might be a little bit tricky. She paid for this paper on credit. So it might be tempting to put cash there first and credit the cash account, but we're actually going to use a new account called accounts payable. Accounts payable is a liability account. Liability accounts increase with a credit. And so if you're not familiar with accounts payable or paying on credit, lots of companies will make sales and pay for things on credit. So they're not paying cash right when they put the order in. They might wait until the manufacturer sends them the bill or until the items are received. Either way, it's not being paid in the exact moment. So we have an obligation to pay, we have a liability to pay, and that's why we record this accounts payable account instead of cash. When we go to do our T-charts, we have a new accounts payable T-chart. It's a liability, so we credited it, and we have the $1,000 there in the credit column. And then inventory up here as well, we debited that. It's an asset in the $1,000 for the debit column. Our next transaction, Ryan pays the monthly utility bills for $250. It's impressive he did anything at all. So we have a very similar situation before as rent. The rent expense example, this is going to be utilities expense. We will debit that and increase an expense as a debit for $250, and we're going to assume that this is paid with cash. It doesn't say otherwise, and we would assume normally that we'd be paying utilities with cash. Okay, we're going to add these to the T-charts as well. $250 credit on cash, $250 in the debit column for utilities expense. Next, Michael pays salaries to Pam and Ryan totaling $800. He might have forgotten that he has to pay his employees. I love this scene when he says, "Can you re-crunch the numbers?" Nothing changed. So that's always a funny one. But anyways, we have another expense here to the company, right? Salaries expense. Okay, it says it's $800. What do you get paid in when you get paid at your job? You get paid in cash. So this is a decrease in cash. That's going to be a credit to cash for $800. Add that to our T-chart. We have $800 in the credit column for cash, and then new chart for salaries expense, $800 there in the debit column. Oh no. Kevin comes over to visit the Michael Scott Paper Company, spills his chili all over the ground. Michael pays a cleaning company $100 to clean up the spill. Thanks, Kevin. Okay, we're paying the cleaning company. We are just going to call this cleaning expense. Again, we've got a bunch of expenses here, and these are all treated very similarly. $100 increase, debit side. And again, we're going to assume that we're paying cash here. It says nothing about credit, so we'll assume that we're paying cash. $100 in the credit column on cash, $100 in the debit column on cleaning expense. Alrighty, here's our last transaction. Michael comes in clutch, closes a huge sale. He sells $800 worth of the paper that Pam bought, and he sold it for $5,000, sales price of $5,000, and the customer paid on account. Okay, so this one's a little bit of a challenge because we've got two different numbers in here and a few different things going on. So I always think the easiest thing to do first is record the sale. So we made a $5,000 sale. At first you might be thinking, we received money, we received some cash, we should debit that, but actually we've got to pay really close attention to the customer paid on account. This is kind of what we were talking about earlier. Instead of accounts payable though, we're going to call this accounts receivable. Instead of owing the money, now we are owed the money. We are the ones who are going to receive the money. So even though we haven't received cash yet, we need to record an asset. We need to record that we are owed $5,000. So we have a debit to the asset account, accounts receivable of $5,000. And our credit is going to be sales revenue. Revenue is always increased with a credit. Okay, so you might be thinking we're done there, but we actually also have another part of this transaction. We need to adjust the inventory that we sold. So originally Pam bought $1,000 worth of paper inventory. We just sold in this transaction $800 worth of that. So asset account inventory, asset accounts decrease with a credit, and we got rid of the inventory, right? We sold it, it's gone, so we need to decrease that. So we're going to decrease inventory with an $800 credit. This leaves us with our debit. Our debit's actually going to be cost of goods sold. If you haven't heard of this, this is an expense account, even though it doesn't say expense at the end. We're going to debit this for $800. And what you can kind of think about with cost of goods sold is it's the transfer from inventory over to expense. The inventory account is an asset. It's something that we're going to sell soon. But once it's sold, it becomes an expense to us. And the expense is recognized in cost of goods sold. So we have cost of goods sold for $800 on this sale. And we'll use that later to calculate our profit on the income statement. Add these final numbers to our T-charts. Cost of goods sold, debit 800. Inventory up here, this is a good one to know. We credited 800. So we bought 1,000 earlier on the debit side. We sold 800 on the credit side. We'll kind of jump a little bit ahead and see that when you net those two out, we are left with a $200 debit balance, which means we have $200 worth of inventory left. And then down here for the sale, we have a 5,000 debit in the accounts receivable chart, and then a 5,000 credit in sales revenue. Okay. So from here, we want to make our trial balance. And now that we did these T-charts all the way, you'll see how easy it is to kind of total and sum all the transactions for the month. So for each T-chart, you take the, depending on if it's an asset or liability account, which balance it should have. We take, for cash example, 10,000 and subtract out all these credits for the month. So we're left with a debit balance of 3,350. Now, a lot of these accounts only have one number in them, so you simply just bring those down. So the 10,000 in equity comes down. Equity carries a credit balance, so it's on the right side. Assets carry a debit balance, and they come down on the debit side as well. So we go through and we total all of these T-charts, and we have an ending account value for each of these accounts listed here. And then from here, to make our trial balance, we simply just list out the name of the account and then the total or the net balance at the end of the month. And so you'll see that here. I went ahead and put it together for us, but we went through each account here and listed the account name, and then we list the balance either as a debit or a credit. And again, if you don't remember if it's a debit or credit, we're looking back and seeing which side. Is it on the debit, the left side of the T-chart, or is it on the credit side, the right side? And then we're bringing here into our trial balance. One thing you can do to check yourself at the end to make sure that you did all your transactions correct is to sum the debits and the credits. Remember that each journal entry was balanced, so our trial balance should also equal each other, the debits and credits. The credit side is going to be a little bit easier. 10,000 plus 1,000 plus 5,000 is 16,000. And let me put it one more lower here. 16,000. And when I get my calculator out and add up all these on the debit column, we also get 16,000. So this is a good check to know that, okay, everything we did so far was correct. We balanced all of our journal entries. From here, we're going to go ahead and now we're going to make the financial statements. The financial statements that we're going to do today are just the income statement and the balance sheet. And what's cool about this trial balance is that each account on here, starting at cash and ending with sales revenue, each account will go on one of the two financial statements. They will either go on the income statement or the balance sheet. So as we use the accounts, we're going to actually highlight them and cross them off, showing what we've used to keep track, so that when you're putting these together, you're not confused or you don't worry about putting them on both or missing one of them. So that's just a fun little helpful tip as you're making your financial statements. So we're going to start again with the income statement. The very first item that we want to start on with the income statement is sales revenue. We had sales revenue of, let me check, down here at the bottom, 5,000. The next thing that we want to do is we want to take out our cost of goods sold. Our cost of goods sold, if we remember, I believe was 800. And let me highlight sales revenue that we've used it now. Go with green. And then cost of goods sold. I'm going to put a negative here because we're going to subtract it out. So when you take sales revenue and then subtract cost of goods sold, you get what we call gross profit. This is simply sales minus the cost of the product that we sold. And that is going to get us $4,200. Next here, we're going to list out our expenses. We can actually call them operating expenses because we don't have any other expenses. Other expenses on a more detailed income statement might include administrative or selling type expenses. So now that we have our gross profit, we're going to go through and list all of our other remaining expenses from the trial balance. Here's a helpful tip if you're confused or you're not sure which ones we need to include. Remember that our expenses always carry a debit balance. So we know for sure that accounts payable and equity will not go on the income statement. That's an equity account and that's a liability account, and those will actually go on the balance sheet. So we start at the top. It looks like our first expense, not cash, not assets, is going to be rent expense. Let me highlight this for $500. Next, we have, it looks like utilities expense for $250. Then salaries expense for $800. And I'm going in order from top to bottom, but there really is no incorrect way to do this. You could put them in any order. Cleaning expense from Kevin's Chili. Okay, and that looks like our last one. We are just left with cash, owner's equity, assets, inventory, accounts payable, and accounts receivable. Those are all balance sheet accounts. Okay, I'm going to put a total here, total operating expenses. And let me see when we add these up. 500 plus 250 plus 800 plus 100 is 1650. And now at the bottom here, we're going to have net income. We can put loss in parentheses. And so now we're going to take our gross profit that we calculated earlier and subtract out our total operating expenses. So we're going to take 4,200 minus 1,650, and we get 2,550. This is a positive number, so it's net income, but if our expenses were higher than our gross profit, then we would have had a net loss in this case, and it would have been negative. So now you successfully made the income statement from the Michael Scott Paper Company. Now we'll pivot over to the balance sheet. Okay, here's a simple balance sheet. We've kind of already got the titles and some of the categories out for us. What we need to do on the balance sheet is list all of our assets and then all of our liabilities and equity. According to the accounting equation, total assets will equal total liabilities and equity. So let's go back to our trial balance and start with assets. Cash is the first one that sticks out to me. Cash is an asset. So cash of $3,350 will go in the asset section. Great. Next, owner's equity. We said earlier again that this is an equity account and it has its own spot on the balance sheet. So this balance of $10,000 is going to go in equity. We'll just call it owner's equity. Next account is asset, laptops. Obviously by the title, we've talked about it already, but that one is an asset account. We'll put laptops for $5,000. Next, inventory. That is another one of our asset accounts that we talked about. It's got a debit balance also, so we know that it's going to be an asset. That would be a giveaway too, obviously. All of our assets will have debit balances. Anything on this right side is going to go either in liabilities or equity, just by the nature of their normal balances. Inventory, 200. Accounts payable. This is a credit balance. This is a liability. balance payable. We said that this was 1,000. And then our final one here is another asset, accounts receivable, with a debit balance of 5,000. Okay, so now that we have all the accounts on here, we can see this trial balance is completely green. That's perfect. That means we've used every account. It's in one spot, either on the income statement here or it got put on the balance sheet. Now we're going to total our assets and then total liabilities and equity. And again, as the title states, balance sheet, these two amounts should balance. So we're going to add 3,350 plus 5,000 plus 200 plus 5,000 again. And we get 13,550. Okay, and then when we do a quick addition down here, it seems like total liabilities and equity is actually 11,000. So it seems like something's off. We might be missing something. And this is the one tricky part about the balance sheet, actually. There is one account that we need on the balance sheet that wasn't on the trial balance, and that might seem a little bit tricky, but it's actually going to come from our income statement. So if you'll note down here, the net income that we had was $2,550. What happens to the income after the period's over? That amount of income has to go somewhere, and it's actually going to become something that we call retained earnings. Retained earnings is an account that keeps track of the earnings of the company, and it actually is considered equity. So whatever we have on the income statement as net income or net loss, if it was negative, we actually bring it over here into retained earnings in the equity section of the balance sheet. And then once we add that retained earnings or net income, we'll see that we actually get 13,550. And now this makes our balance sheet perfectly balanced. Again, that part is a little bit tricky, but again, the retained earnings is the residual income, what income's left or the loss that was left, and that gets applied to equity. It either increases the equity or it decreases it if it was a loss. In our case, it increased it. But this balance sheet is balanced. You've done it perfectly for the Michael Scott Paper Company. I really hope you enjoyed this video, guys. We just went through some journal entries, some practice transactions. We used T-charts to see how those can be a valuable tool to learn your entries and to see how different accounts are moving and working together. Then we went through a trial balance, we did an income statement, and we did our balance sheet. If you enjoyed this video, please subscribe. If you have any questions, again, please leave them in the comments below. If you want to see something else in a future video, again, please leave a comment below. Thanks again for watching and have a good day.